Good morning, it's Jeffrey Christian of CPM Group. It's about 10:42 in the morning here in New York on Friday, the 23rd of August. Gold is trading around $2,538 per ounce for the December contract right now. It did touch a new record on an intraday basis, if not on a settlement basis this week. Silver is around $29.35. I'll get back to those in a little bit while. But I want to talk about central banks and why they own gold. And I'm going to do that primarily because somebody asked a very good question about it. Get to that in a second. And I'll sort of try to generalize the lesson from why central banks own gold for investors. I'm going to continue with a program I started on Tuesday where I have something. It's not really related to gold, but it is related to gold in a way because it's a very good reason for private investors to be stocking up on gold and silver. Sort of a parlor game that I've created called Justify This. We'll get to that, and then I'll wrap it up with a little bit of a market update and outlook. In a comment related to one of our videos, someone asked a very good question. I appreciate your work. If gold is inconsequential to monetary and fiscal policies, then why do central banks hoard gold and continue to buy gold? And I guess part of the answer is first that it's not that gold is inconsequential to monetary and fiscal policies per se. There are some uses for gold in the monetary application, and I'll talk about that in a second. But what it is that gold is such a small market compared to the broader financial market, the money in circulation and such, that it is less important. It also has lost some of its functions, monetary functions. So to start with, it's like understand the functions of money. Money is a store of value. It's a medium of exchange, and it's a unit of account. Store value with money. You can use that money to buy things, goods and services, and live and trade. And it's a unit of account. It's a way to value what other things are worth. Now, there's a very important thing, people who say incorrectly that the U.S. Constitution says that only gold and silver can be money. It actually doesn't. But what it does say is that the money that the U.S. government is permitted to create under the Constitution will have a certain value as a unit of account against unnamed assets. And that unnamed asset happened to be gold and other currencies in the world. Now, if you look at gold, gold no longer is an official unit of measure of the value of other currencies and other things. So it's lost that unit of account value. It's no longer used to settle international trade and capital flows. So it's no longer used as a monetary medium of exchange. It's still used in many places as a private sector medium of exchange, but in the monetary system, it's not used as a medium of exchange. It is still a store of value. It's a reserve asset. CPM Group, when even before I left JR and Goldman Sachs in 1986, I was working with central banks and talking to them about gold and our views of gold and such. And after we left CPM Group, we did a lot of work in a research and consulting program called the Normative Role of Gold in Monetary Reserves. I'll talk about that in a little bit when I get into this a little bit more. Well, this is where I was going to talk about it. Central banks bought a lot of gold or acquired a lot of gold from 1950 into 1967-68. That was a time when gold was used as a means of medium of exchange. The U.S. entities were buying a lot of goods and services from around the world, paying for them with dollars. The recipients, the people who were selling those goods and services, would turn those dollars into the banking system in their countries, which would turn those dollars to their central bank, and their central bank would come to the U.S. Treasury and say, I have dollars. You have a fixed gold price of $35 per ounce. Here are your dollars. Give me your gold. And from 1950 into about 1968, central banks were doing that. They actually were continuing to do that until 1971. But in 1968, Lyndon Johnson closed the private sector gold window. Prior to that, anybody could go to the Treasury. There was literally a window at the U.S. Treasury where you could go and say, here are my dollars, I want some gold. Except if you were a U.S. citizen, because gold ownership was not allowed unless you had a use for it in your business. My father was a sign painter, and he was very adept at gold leafing. So doctors' offices, lawyers' offices, other windows and stuff. And he had a treasury license that allowed him to own gold. But that's beside the point. 1968, Lyndon Johnson closed the private sector gold window. 1971, Richard Nixon closed the public sector gold window. And gold ceased to be used as a medium of exchange on a monetary level. It was no longer used to settle international trade and capital flow differences. For a period of time from the 70s into the 80s, there were a lot of central banks, mostly industrialized countries, that were involved in international trade that had a lot of gold in their monetary reserves, and a lot of their monetary reserves were denominated in gold. And they sort of said, what are we going to do with this stuff? They started to lease some out to earn interest rates. And I'm happy to say that I was part of an early group of people who were working with central banks to create the gold leasing business. And we would go to central banks and we'd say, we would like to borrow your gold. And they'd say, how are you going to do that? I'd say, we'll borrow your gold and we will pay you an interest rate. All right, this is okay. I won't go into all the boring details, but that started working. At first, central banks would say, what are you going to pay? And we would give them an estimate of what we would pay them in terms of interest for borrowing their gold. And they'd say, that's not a lot. And we would say, well, what are you earning right now? The answer was nothing, because the gold was just sitting in bank depositories or central bank depositories around the world, not earning interest. Other central banks were selling gold, and you can see there was a period of what they called demonetization of gold, in which the IMF and the United States Treasury sold quite a bit of gold in the late 1970s. And in our gold yearbook, we actually have the tables of those gold sales and gold auctions bought by the U.S. Treasury and by the IMF. Over the course of the 80s, central banks started selling more gold. Again, the industrialized countries that had 80, 90, 95, 97% of their monetary reserves in gold, they needed currencies to pay for their international trade, imports, and capital flows. So they started selling gold. In 1989, the Maastricht Accord came along and said, we will create the Euro and the European Central Bank starting January 1st, 1999. That led to a period, that you can see here, of larger gold sales by those central banks in Europe that were opting into the European central banking system and going to go from their domestic currencies to the euro. They had until January 1st to be able to discreetly and privately and secretly sell their gold. And it was a very private and secretive business back then. In 1999, Switzerland and England, both of which had decided not to participate in the ECB and the euro, they commenced selling gold. Each of those countries wanted to sell at least half of their reserves. England had about 20 million ounces. They sold about 10 million ounces. Switzerland had, I think, 90 some odd 86 million ounces. They sold 43 million ounces over the period 1999 into around 2006, 2007. By that time, the central banks that had wanted to sell some of their gold had sold the gold they wanted to sell, and the volume of gross sales by central banks fell off sharply. About the same time, we ran into the global financial crisis and the Great Recession, and there were any number of other central banks, the Asian tigers, China, to some extent Russia because of higher oil prices, that had not built up a lot of gold reserves earlier, but had built up a lot of dollar reserves because they had grown very strongly in the 1980s, 1990s, into the aughties. They had a lot of dollars, 80, 90% of their foreign exchange in some cases were in U.S. dollars. So they were selling dollars to diversify their reserves, and they were buying gold. And you started seeing net purchases by central banks in that period of time. So you had central banks say, we want to diversify our monetary reserves. Those central banks that had a lot of gold wanted to diversify their reserves away from gold into dollars and other currencies. And those central banks that had a lot of dollars and currencies wanted to diversify their their monetary reserves into other currencies other than the U.S. dollar and gold. Both of them were the same impulse. Let me diversify my monetary reserves. But the actual transactions involved to diversify the reserves were the opposite one to the other. That's where you have it. Central banks, and in that environment, as I said earlier, in the late 1980s, CPM Group came up with a program called Normative Role of Gold in a Monetary Reserves. And we went back to that. Money 101. What are the functions of money? What are the functions today in the 1980s and to the present and probably into the future? What are the functions of gold, the monetary functions of gold? And we wrote at the time publicly about how gold has three sets of functions: monetary functions, financial functions, which are non-governmental private investment functions, and as a commodity. And gold continues to be a commodity. Gold continues to be a financial asset. It trades like a financial asset. But its monetary roles are now limited to being a monetary reserve and a reserve diversifier. That's where we are. And that's why central banks buy gold. You can see here the lighter blue line, central bank reductions of central bank gold reserves, really starting in the early 60s and then bottoming out around 2006, 2007, at which point net purchases took over and central banks have been rebuilding their reserves almost back to where they were in 1962. In terms of currencies, central banks are not dumping dollars. The dollar has been relatively stable for the last 20 years. What they have been doing is reducing their euros. And again, Rohit Savant, my colleague who is a major author of our Gold Yearbook, spoke very eloquently in our Gold Yearbook briefing about that. Euro reserves as a percentage of foreign exchange reserves have declined from about 29% to around 19% over the last 20 years, while U.S. dollar reserves have been relatively stable in the 58 to 62% range, except for that run-up in the late 1990s when central banks that were opting into the euro had to sell their reserves of other central banks that were opting into the euro because those currencies would cease to exist. So France, Germany, various other European countries, Italy, Spain, Portugal, were opting into the euro. They had reserves of each of those currencies. They had to dispose of those. So they did, and they bought dollars. And you see this increase from about 58% of reserves 1995 into January 1990, at which point they got rid of their other currencies. They had euros, Well, they didn't have euros because it was no longer a foreign exchange. It was no longer a foreign currency for them. So you can't have your own currency as part of your foreign exchange reserves. That's one of the reasons why the U.S. dollar, the U.S. Treasury has most of its reserves in gold, because it can't hold dollars as a foreign exchange reserve. Same was true in Europe. But what we've seen over the last couple decades is a reduction in euro holdings, stable U.S. dollar holdings, and an increase in what shows up here as other. That's currencies other than the pound, the yen, the euro, and the dollar. So central banks aren't dumping dollars. There's no dollar de-dollarization going on. Anybody who talks about that is either just simply inaccurate or they're consciously misleading you. This is the composition of total central bank monetary reserves, which include not only foreign exchange, but also gold, an IMF reserve position, and special drawing rights, which are a pseudo-currency issued by the IMF to other central banks. You can see the gold part as a percent, as a composition in dollar terms, has risen over the last 20 years. That partly reflects the increase in purchases, an increase in actual reserves that I showed you earlier. But most of the increase reflects the fact that the gold price has gone from $250 in 2001 to $2,538 today. I want to shift gears because I'm also hearing that central banks are getting out of, they're repatriating their gold in a very rapid fashion because they don't want their gold to be held by the U.S. government. Central banks hold gold in various depositories around the world. One of the big depositories was the Bank of England, still is. Another one is the New York Fed. The New York Federal Reserve Bank holds gold for other countries' central banks. And you can see here, they have about 184 million ounces of gold that they're holding, what they call earmarked gold, on behalf of other central banks. Now, I'll show you, I'll run through some points in a second. I put them in writing so that you could see, so you have them. But I want to point out that this decline, 1985, 340 million ounces, down to about 200 million ounces up until by 2009, and at that level until 2015. That didn't represent central banks patriating. It wasn't a matter of repatriation because the gold never was really in their depositories in their own home countries. It didn't represent patriation of their gold. What it represented was central banks selling gold during that long period of time and leasing gold out. If you're a central bank, you can hold your gold in the New York Fed. The Fed only holds gold for central banks and to some extent the U.S. Treasury now. It used to not be accept U.S. Treasury gold. That was held over at the U.S. Assay Office. And then at a mint, Mint's various depositories in West Point, Fort Knox, Denver, and other places. This decline represented selling and leasing gold. If you wanted to lease your gold out to a private entity, you had to take it out of the New York Fed. A lot of that gold was ultimately taken out, leased out to companies that used the gold for 30 days or 90 days or a year or 2 years. And then when they unwound the lease, they returned good delivery gold in London. See, the gold that was built up at the Fed was built up prior to 1971. And the good delivery standards were changed in the late 1970s, early 80s. So that the gold that was in the New York Fed, by definition, was not Well, not by definition. Some of it could have been good delivery, but most of it did not meet modern or updated gold delivery standards. So when a bullion bank would borrow gold from a central bank, they'd take it out of the New York Fed. They would lend it to fabricators, jewelers, electronics companies, mining companies for project finance purposes, investor groups that were using gold as collateral for various investment products. And when they returned the gold at the end of the lease period, they would return good delivery gold at the Bank of England. So you saw an increase in the amount of central bank gold held in the Bank of England and a decrease of gold at the New York Fed. That's a little bit of history, but I'm sure that any number of people can look at this and say, hey, look at all that gold that was being taken out of the Fed for reasons that were not actually real. You did see a decline in 2015 to 2018. That was the repatriation of some of the gold that the Bundesbank held in New York back to Frankfurt. Not back to Frankfurt because it had never occurred. It never had existed in Germany. The central bank Bundesbank's gold was acquired basically starting in 1950 through 1971. It accumulated in Paris, London, and New York. And in the period around 1950, ultra-nationalist parliamentarians insisted that the Bundesbank repatriate some of the gold back to, not repatriate and not back to Frankfurt, patriate, bring some of that gold home. And they did that because they were ultra-nationalists. And the Bundesbank and other more rational entities within the German government were against it. They said, no, we want to hold our gold as far away from Russia as possible. And that's why most of our gold is in New York. And they reluctantly did that. Now, I'll get back to the Bundesbank in a second. Just to review, central banks are not moving gold out of the U.S. Oh, I forgot the most important thing. If you look at this in 2023, central banks added 4.2 million ounces of gold into their deposits at the New York Fed. So anybody who tells you that central banks are taking gold out of the Fed and moving it overseas because they don't trust the U.S. government, and that. In fact, central banks are not moving gold out. You saw 4,192,000 ounces go into the Fed's holdings for other central banks between April and November of 2023. If you look at gross purchases of gold by central banks as a group, that 4.2 million ounces represented 36% of gross purchases in that 8-month period. It represented 75% of the net central bank purchases. And perhaps just coincidentally, Poland's central bank, Narodowy Bank Polski, bought 4,182,000 ounces in that same 8-month period. There's a good probability that a large part, all but 12,000 ounces, of the 4.2 million ounces that were added to the Fed were added to the Fed's holdings by the Central Bank of Poland, which is obviously extremely concerned about the proximity of a newly militant, increased militant Russia. Well, gold, but let's not hold it where the Russians can get it when they roll over us again, if they choose to try. I don't think they will because Poland's part of NATO. But that's a little bit of the history. Now, the decline, as I said, in the earmark gold from 85 to 2008 had nothing to do with repatriation or distrust of the United States government or de-dollarization. It had all to do with leasing and selling, as I said earlier. And the Bundesbank debunked promoters' nonsense in a 2015, I want to say, CPM Group Gold Yearbook briefing. Henner Asche, who was a Bundesbank executive responsible for managing the repatriation of the gold program from London, Paris, and the U.S., came to New York and spoke at our gold briefing back at that time when we actually had physical briefings instead of totally virtual. And you can watch his presentation on YouTube at this link here. Sorry, strangely, only part of it is in blue. That is a link to an hour and a half or so presentation. And at the 1 hour, 6 minute mark, he starts speaking on this and pointing out that it wasn't a repatriation because the gold had never been in Germany, and that the Bundesbank was against it because they had a policy of keeping the gold as far away from Russia as possible, and New York was as far away as possible. And they kind of were worrying because by 2015, you were seeing increased militancy on the part of the Russian government under Vladimir Putin, and that's where it was. So that's a little bit about central bank gold. Central banks hold their gold as a diversification. All of these charts, they're in our gold yearbook. You can buy the gold yearbook for $160 at our website. Central banks buy gold and hold gold to diversify their monetary reserves. And diversification works for everyone, not just central banks, but also investors large and small. So that's the conclusion, the takeaway from this. Now, my new parlor game, justify this. A little bit of background. In 2018, the Prospectors and Developers Association of Canada asked me to speak at their big conference in March in Toronto on the way Russians and Chinese governments and people view the world. And in my talk about the way Russia, a government under Putin, and about 50% of the Russian population, which is devout Russian Orthodox, they have a view toward the U.S. and the West. They see us as being barbaric. They don't see our societies as modernizing. They see it as a fallback to a reversion to more primitive pre-Christian culture. They see pro-choice, allowing abortion, tolerance of homosexuality, all as sort of reversions to an earlier, more barbaric time. They also see the arrogance of the United States, and to a lesser extent parts of Europe, maybe not to a lesser extent, as needing to force the rest of the world to accept the West's modernist view. They don't like that either. So, and they also have very thin skins. This week, on August 20th, Vladimir Putin said he would fast-track a new decree offering residency to people who wish to flee the destructive neoliberal ideological attitudes of the United States and Western Europe. And Russia would provide a safe haven in which traditional values would reign supreme. Not exactly safe, because I believe that you would actually be exposed to the Russian military draft, if you became a resident there. The title of this decree is on the provision of humanitarian support to persons sharing traditional Russian spiritual and moral values. So he said that on Tuesday the 20th. On the 21st, I believe he said that he would offer amnesty. Is not amnesty. If Donald Trump needed to flee the United States, he could come to Russia, and Russia wouldn't deport him back to the United States. So that's sort of the way Vladimir Putin is thinking about the world right now. Now, here's the parlor game. Let's say that a person who agrees with Vladimir Putin that Western culture is barbarian, with all of this, tolerating homosexuality and abortion and letting people read whatever they want and stuff like that. And, say somebody in the United States wanted to have a nice long conversation with Mr. Putin about their shared values. They believe that stuff. They agreed with him. And, what can we do to save the world from this barbarian Western modernization culture that's really a throwback to pre-Christian times? Let's say that you want to do that. And let's say that you have the capacity to arrange such a meeting. And what would you do? You would fly to Russia and have that meeting. But what if the person is a Supreme Court justice and he believes all that stuff and he's very much interested in what can be done to save the world, the West and the United States from these barbarian impulses of allowing homosexuality, abortion, and even mixed race marriages? What Clarence Thomas and Harlan Crow did was Harlan flew Clarence Thomas to a city outside of Russia, but close to it. Then they took a private yacht across the Baltic to Russia. And then they took a private helicopter to meet with Mr. Putin. Why would you do that? You try to justify a Supreme Court justice wanting to go to Russia to speak with Vladimir Putin about what can be done to save America and Americans from this atrocious barbarian culture that we have here. I don't want your responses. I think it's just the kind of thing you pour, a nice glass of wine or whiskey with your spouse, and you sit around on a Friday night and say, well, let's see, how do I justify this? It's very strange. And there's a link where you can find an article about it, although there have been several articles all over the place, talking a little bit about the markets. Gold, as I said, $2,538 for the December futures contract. It did reach and touch a new high this week. CPM Group has been saying that it thought that the gold price would reach new records in the final 4 months of this year into 2025 for a variety of political and economic reasons. We still agree with that. We're putting perhaps a greater percentage on an alternative scenario where things actually get better. But we think that between now and say the first or second quarter of next year, and any improvements in international and domestic economics and political situation probably will be slow to emerge. You are seeing increased rumblings now that Ukraine has been allowed to attack Russia within Russia, and it has, and it's had some good successes. You are seeing increased rumblings within the Russian elites about replacing Mr. Putin, getting out of Ukraine, and trying to find a more peaceful relationship with the West. You're also seeing discussions within China about how can we improve our relationship with the rest of the world, not just the United States, not just Europe, but really the rest of the world, and maybe back away from the militants that we've had in terms of Taiwan and also the South China Sea. You have other economic and financial and political issues that could get better. But right now, CPM Group still thinks that we're headed toward a period of worse economic and political conditions, which will probably propel gold prices significantly higher over the next 18 months or so. So that's where we are right now. We have one week left in August, and then we get into September, and there are interesting developments all over the place. Silver, $29.35. It has been struggling. It has gotten over $30, and it was trading over $32 briefly back in May. It stayed above $30 in early July. It's headed back that way, but it's got a lot of headwinds. You're talking about the active September contract, which becomes deliverable next week, but you've already seen more than half of the open interest in September roll forward into December. So that's probably not going to provide any sharp increase in silver prices over the next week or so. We think that silver stays. It has a good base above 27.50, 27.50, but it also has a lot of people who are trading short as well as long, whereas in gold, you've really seen a reduction in the short positions. In silver, you still have a lot of people who think that the potential for silver to fall to $26 or even lower exists. So we'll see where that goes. That's all I have for now. Have a good weekend. Take care of yourself. Take care of people around you. Try to do something good for the world. And have fun with that parlor game. I mean, try to justify a Supreme Court justice saying, hey, let me go to Russia and talk to a dictatorial tyrant about what he and I can do to make America great again. And I'm so certain of the rectitude of my actions that I'm going to fly to a country near Russia, take a private yacht to Russia, take a private helicopter to meet with Mr. Putin. Now, there's a saying, I never stab you in the back. I want to see your face. Mr. Thomas clearly is not of the ilk to say, let me do this in public. But then, that's that. Have a good weekend. Take care of yourself. Take care of others. I'll see you next week.